Hi, this is John Comarianos with Capital Considered. There are very strange things going on in the municipal bond market right now, and I think investors should take notice. Even those who aren't in the highest tax brackets, those are the investors usually interested in municipal bonds, but the dislocation is so significant right now that even those investors not in the highest tax brackets should take note of what's going on and maybe take some action. First of all, let's set it up here. We have a chart here that shows year-to-date returns. So from January 1st through April 24th, the Bloomberg Municipal Bond Index, represented by the blue line, is down 1.78%. This while the Bloomberg U.S. Aggregate, the main taxable investment grade intermediate term bond index, is up 2.33. So one's down almost 2, one's up over 2. That's a pretty significant dislocation. And on the cluster on the right, if we take that return or those two returns from April 4th through April 24th, we see again the muni bond market index, the Bloomberg Municipal Index, is down 1.85, and the Bloomberg U.S. Aggregate is down, but only 0.64. We took it from that date because it's a significant date. It's a couple of days after Donald Trump announced the tariffs, subsequently reduced them or delayed them. But a lot of money has moved out of the bond markets, especially by foreign investors. And so that explains the aggregate's decline since then. But the muni bond market decline is just breathtaking. Now, what does this mean for investors? Let's go to a next chart and we'll be able to illustrate that a bit better, I think. Here we're taking a money market fund, not a bond fund, but it's the principle is similar here. So we're using the Vanguard New York Municipal Money Market Fund. This is yielding 3.92% today, as you see. The taxable equivalent, if you're a New York State resident and you're in a 25% total tax bracket, so that would be your federal tax bracket plus your New York State tax bracket. That would be, if you were in that bracket, that would be 5.23% taxable equivalent. That's a very good yield. No U.S. Treasury security can give you over 5% right now. Let's take it a step further. Let's say you're even in a higher bracket. You make a lot of money. You're in 35% federal bracket. Maybe you pay 10% to New York, so your total tax bracket is 45%. That 3.92 that you're getting in the New York Municipal Money Market Fund is the equivalent of 7.13% taxable. That's astounding for a pretty safe instrument like a New York Municipal Money Market Fund. Now you may say, well, lending money to New York State is not the same as lending to the federal government. Some truth to that, but on the other hand, municipal default rates are extremely low, extraordinarily low. It's also worth noting that analyst at Schwab, Cooper Howard, doesn't think this dislocation is credit related. He wrote an article on the Schwab website that has also appeared on the Advisor Perspectives website saying that. Let's just make a quick note of the math here, how to convert tax-free yields into taxable equivalents. So the tax-free yield divided by 1 minus your tax bracket is the formula. So the tax-free yield over 1 minus 0.25, if you're in the 25% total tax bracket, would give you the taxable equivalent yield, or the tax-free yield divided by 1 minus 0.45, if you're in something like a 45% total tax bracket, federal and state, would give you the taxable equivalent yield. So that's the quick math behind all of this. So I think this is worth considering for certainly people in the highest tax brackets. And this doesn't only apply to New York. We're just using a New York example. This is worth considering for people in the highest tax brackets, and even worth considering for people not in the highest tax brackets. There's no telling how long this dislocation will last. This New York Muni Money Market Fund was yielding 4.05 2 days ago and 4.01 yesterday. It's down to 3.92 today. So the dislocation may be rectifying itself even as we speak. But this is still compelling, even if it doesn't last a long time and you wind up switching back into taxable bond funds afterwards. If you use a bond fund and not a money market fund, there could be tax implications to doing that. So think about that, talk through that with your advisor. But I think switching to munis right now is worth considering for a lot of investors. Just to review munis for a second, a municipal bond gives you interest that's federally tax-free. If you live in the state in which that bond is issued, it usually means that interest is state tax-free as well. And if you pay local taxes, as you do in New York City and other places, usually that interest, if the bond is from that state, is tax-free on that level as well. So triple tax-free, we might say. So muni bonds can be really attractive. They're rarely this dislocated or trading this cheaply. Worth a look. Consult with your advisor, of course, about tax consequences. Anyway, this is John Komarianos for Capital Considered, signing off. Thank you for watching. Please click like and subscribe if you like our content. Thank you.